Hello everyone, I'm Ali, and in this video we will illustrate the auditor's legal liability to their client, contributory negligence, and the extent to which an auditor is liable to third parties. The auditor must exercise due care when conducting an audit. This means that the auditor must be diligent in applying the appropriate standards and documenting the work completed. If the auditor is found to be negligent, they may be sued for damages by their clients or a third party. Liability can arise in contract law and tort law. Under tort law, to prove that an auditor has been negligent, a complainant must establish that a duty of care was owed by the auditor, there was a breach of the duty of care, and a loss was suffered as a consequence of that breach. Tort law is a body of rights, obligations, and remedies applied by courts in civil proceedings to provide relief for persons who have suffered harm from a wrongful act of others. The person who suffers damages is known as plaintiff, and the person alleged to be responsible for inflicting the injury and accused of being liable for the damages is known as the defendant. Liability, as I said previously, can arise under either contract or tort law. For legal liability, a very first thing client must prove that the auditor owes them a duty of care. A client can establish that its auditor owes them a duty of care using either the tort of negligence or contract law. Under the tort of negligence, the client must prove that the auditor failed in the performance of their audit by being careless and breaching their duty of care. Under contract law, the client must establish that the auditor breached the duty of care to their client that is implicit or contained in agreeing to act as an auditor. It was made explicit or clear in the engagement letter. An auditor's duty of care to their client has been established and defined through case law over time. In these cases, the definition of reasonable care and skill has changed over time to reflect the changes in professional standards. To prove that an auditor has been negligent, a plaintiff can be client or third party, must establish that an auditor did not comply with auditing standards, ethical pronouncements, or an element of the law in place at the time of conducting their audit, or apply due care when conducting their audit. We'll be looking at a few cases. London and General Bank case established that the auditor has a duty to report to shareholders directly. One of the problems in this case was that the auditor had only reported to the directors. Now, remember that shareholders are the owners of the company and they need to be informed directly. The auditor must be honest and not certify what he does not believe to be true, and must take reasonable care and skill in making inquiries and investigations. The auditor is not an insurer. He does not guarantee that the financial report does correctly show the true position of the company's affairs. This case provided an explanation of the extent to which the auditor could be held liable for the action of its client. In the Kingston Cotton Mill case, the case established that the auditor is a watchdog, not a bloodhound. That is, the auditor is not a detective. The auditor is not to assume that clients' accounts are materially misstated, and the auditor needs to exercise reasonable care and skill. In the Pacific acceptance case, the case established the auditor's duty and responsibility. So this case went into quite a lot of details as to what should the auditor do, be doing. So the auditor's duty and responsibilities are to use reasonable care and skill, check and see for themselves. This means you cannot rely just on information that's provided to you. You must audit the whole year. For example, you can't just pick the 1 month, and you need to spread your testing throughout the whole year. You need to closely supervise and review the work of January staff. You're required to properly document the procedures used. And you need to warn and inform the appropriate level of management if you come across something that has not been correctly done. You need to take further actions when suspicion is aroused, and you need to be guided by professional standards. This means your accounting standards, your auditing standards, and any other regulations that may be required depending upon the industry your client belongs to. The HIH Royal Commission report in 2003 made a number of recommendations that we need to take note of, in particular in relation to auditor independence. Auditor independence is a critical element of establishing the credibility and reliability of an auditor's report. It's widely accepted that the auditor must be seen to be free from any interest that is incompatible with objectivity. It is important that you review earlier recording that was done on the auditor's independence. An independent and objective audit conducted with an appropriate degree of professional skepticism is required. Professional skepticism is a term that you will come across frequently in auditing. Professional skepticism means that you have a questioning mind. That means you are provided with some information, and you should be able to collaborate that information with other forms of information. For example, the sales manager may indicate to you that it's been a wonderful year and they have achieved exceptionally high sales. You need to be able to check that what has been recorded in the general ledger. The maintenance of high standards of honesty and proprietary is required by those who are under a duty to act in the interest of others. So again, I'll refer you to auditors' ethical obligations as discussed in earlier videos. Centro Properties Group was also another milestone case. In this case, current liability were incorrectly classified. Now, as a result of this, the directors were found to have breached their duties under the Corporation Act. The executives were also found to be in breach of their duties. The CEO was fined, and the CFO was banned for 2 years. And the auditors also came under scrutiny. The overall findings were that directors cannot rely on their management and auditors when approving companies' accounts. This means that the directors need to have a good understanding of the financial information and the non-financial information presented to them. We now look at a contributory negligence. This is where both plaintiff and defendant contributed to the loss incurred. That is, there was a lack of care from both parties, and in these cases, the courts will establish the percentage of fault. In the AWA case, the company suffered losses due to internal control weaknesses over foreign currency exchanges. The findings were that the management failed to put in place an adequate internal control system. The auditor did not uncover the weaknesses in the internal control system and did report these to management. However, the auditor failed to report to the directors when management did not repair the deficient controls. As a result, both management and the auditors were found to have been negligent and to have contributed to the losses incurred. Legal liability to third parties. What is the auditor responsible? What's the auditor responsibility? Third parties include anyone other than the client and its shareholders who use the financial report. For example, suppliers, lenders. There is actually no contract between the auditor and the third parties. Therefore, the third party must rely on tort law and show there is a duty of care was owed to them by the auditor. Remember, under the tort law, what needs to be established is that there was a duty of care and that duty of care was breached, and as a result of that breach, a loss was suffered. Looking at some examples of legal liability to third parties. In the Chandler case, the investor relied on a negligently prepared audit report and as a consequence suffered losses. The findings of this case were that there was a contractual relationship between the investor and auditor, and therefore the auditors were not liable in this case. And this indicated that it can be more difficult for third parties to establish that an auditor owes them a duty of care. A duty is owed to a specific third party of whom the auditor was not aware, but who was part of a class of persons of whom they should have been aware. This is where the term reasonable foresight comes in. So the result of this was a little bit different from the previous case. This was established in the Scott Group case, where the Scott Group relied on an audited report in formulating a takeover. Findings here were that the auditors were liable to third parties if they can reasonably foresee that the third party may rely on the financial report of their client. The important term here is reasonable foresee. And this case made it easier for third parties to establish that an auditor owes them a duty of care. In the Columbia Coffee and Tea case, the investor relied on audited reports to invest and subsequently suffered losses. In this particular case, the audit firm actually had an audit manual stating that its firm policy to acknowledge that third parties would rely on the audited accounts of their clients. So the findings of this case were that there was a duty of care owed to the third party. The auditor was held liable because in this case the firm acknowledged that third party may rely on the audited accounts of their clients. And therefore, this case made it significantly easier for third parties to establish that an auditor owes them a duty of care. The next case is Isanda. The judge in this case argued against Columbia finding. The court found in the favor of the auditor ruled that for a third party to be able to establish that auditor owes them a duty of care, they would need to establish three things. First, the report was prepared on the basis that it would be communicated to a third party. Second, the report was likely to be relied upon by the third party. Third, the third party ran the risk of suffering a loss if the report was negligently prepared. The judgment in this case provided some relief for auditors, as it made it far more difficult for a third party to establish that a duty of care is owed by the auditor. So now, how the auditor can avoid some of the litigations, what steps they can take. It is important that they hire competent staff. So the staff that hired are suitably qualified and receive regular trainings. As you are aware, the accounting standards and auditing standards are updated on a regular basis. The auditor, as a professional, need to be aware of these changes. The auditor needs to comply with ethical and auditor regulations. They also need to ensure that they implement policies and procedures relating to client acceptance, staff allocation, ethical and independence issue identification and rectifications, adequate work documentation, and that they gather adequate and appropriate evidence to support their opinion. Furthermore, the auditor can meet with the client's audit committee to discuss any significant issues arising in the audit. The audit committee is a subcommittee of the board of directors. The auditors also need to ensure that they follow up any significant weaknesses in the client's internal control procedures from the previous year audit and find out what did actually management do to address what auditors had identified. And in the next video, we'll look at the different phases of an audit. Thank you.